Americans are currently facing a substantial financial challenge with nearly $1 trillion in credit card debt. The cost of living has surged, with increased prices for essentials like groceries and gas. People are feeling the pinch due to inflation and high housing expenses. This has ushered in what is being considered the most severe credit crisis since the 2008 Great Recession. It is not only banks that are at risk. American consumers will also bear the brunt of these changes. The information you're about to hear is not only valuable, it's essential for safeguarding your financial future. Stick around to find out why. Lately, major banks have reported earnings, and they declared that they'll no longer be lending at the same favorable rates as in recent years. Their approach to lending will become more cautious, with a critical eye on who they lend to, how much they lend, and the terms of the loans. The surge in bad loans and the decline of the commercial real estate market have put many financial institutions at risk of collapse. In response, these institutions are taking drastic measures to avoid even more significant losses in the coming months. Nevertheless, given the current outlook for debt delinquencies and defaults, especially as more consumers and businesses resort to credit, many of these institutions are on shaky ground and could face collapse before the year ends, according to the Federal Reserve of New York's analysts. Make sure to subscribe to the channel and leave a like below this video. Remarkably, the credit card market is revealing its vulnerabilities as more Americans grapple with financial hardships. Credit cards are the most prevalent form of household debt and are expected to become even more widespread in the near future. Since 2019, over 70 million new credit card accounts have been opened in the US in the second quarter. Total credit card debt exceeded $1 trillion for the first time. Adding to the woes, interest rate hikes have outpaced consumers' income increases, worsening their financial health. As of the end of the fourth quarter, the average credit card interest rate hit a record high of 24.45%. Retail store cards, in particular, charge over 30%. This has pushed 22% of credit card users deeper into debt each month, as reported by Ted Roseman, an industry analyst for creditcards.com. These findings are part of a troubling survey by the firm. It notes that this year, Americans are using 30% of their take-home pay to cover credit card bills. Between January and September, US cardholders paid $163.8 billion in credit card interest and fees, up from $120 billion in 2020. In essence, using credit cards has never been so costly. Financial advisors predict that it will get even pricier in the months ahead and into 2024. Despite the challenges cardholders have faced in the past year, it's expected that the situation will deteriorate before improving. According to Matt Schulz, chief credit analyst at LendingTree, life is exceptionally expensive in 2023 and is unlikely to become more affordable anytime soon. He advises those looking to finance significant purchases to wait for improved conditions and lower interest rates. Federal Governor Michelle Daley Baumann has also mentioned that more rate increases may be necessary to combat inflation, and that the Federal Reserve expects an effective rate of 5.1% by the end of 2024, making obtaining loans more difficult for most people. For those already struggling to manage credit card payments or other loans, Eric Croak, a certified financial planner and president of Croak Capital, recommends focusing on paying down high-interest debt instead of taking on more debt in 2024. Unfortunately, many credit card holders have already found themselves in a precarious financial situation. Less than half of Americans believe they'll be able to pay off all their credit card debt within the next year. A significant 53% of cardholders have hit their credit card limit at some point, and 29% confess to maxing out their card each month. Official estimates indicate that the average American household carries about $1,170 in credit card debt each month. The monthly credit card expenditure for the typical American has reached $1,056, but millennials, on average, are spending even more at $2,410 monthly. This escalating debt is obstructing their pursuit of long-term goals and their ability to cover essential immediate needs. Roughly 37% of card users admit that their credit card debt hampers their desired lifestyle. It's especially challenging for those aspiring to buy a home, a significant wealth-building milestone that younger adults are struggling to achieve. About 22% of this group has been prevented from homeownership, resulting in high rent payments without the benefit of building equity. Homeownership isn't the sole priority being sacrificed due to credit card debt. 47% reported that their debt prevents them from establishing emergency savings, while a similar percentage, 39%, said it obstructs their retirement savings. As consumers grapple with increased costs for essential goods and services, they often turn to credit to bridge the gap. Notably, 2/3 of Americans attribute their credit card debt to inflation, with almost half relying on credit cards for necessities like food, housing, and energy. Simultaneously, the number of people missing credit card payments is surging. When a consumer falls behind on payments, escaping credit card debt becomes a protracted process, especially with current credit card interest rates. For instance, someone making minimum payments on a $3,000 debt would need nearly 10 years to pay off the principal while incurring an additional $4,000 in interest. Over the past year, 43% of Americans have missed at least one credit card payment, primarily due to forgetfulness, 36%, or while covering groceries, also 36%. Most concerning is the recent increase in delinquencies among credit card users, marking the first such rise since the pandemic. Currently, 5.08% of credit card balances are seriously delinquent, or at least 90 days past due, according to the Federal Reserve. This is the most significant increase since the second quarter of 2022, when the rate was 3.52%. Credit card balances are showing the worst performance compared to other debt categories this quarter, following an unusual period of low delinquency rates during the pandemic, as reported by the New York Fed. Banks are indicating their intention to cut off access to loans and credit. Major credit card issuers have reported growing credit card losses, with Wells Fargo noting a 3.5% increase in delinquencies compared to a year ago, and JP Morgan Chase and Citibank revealing a 1% increase in losses from the previous quarter. Besides rising credit card and loan delinquencies, banks are grappling with the challenges in the commercial real estate sector, as many property owners are dealing with high interest rates and vacant offices due to remote work preferences, which might lead to loan defaults and added pressure on banks. Banks are likely attempting to avoid selling their underperforming properties, as doing so would necessitate larger write-offs, and each sale becomes a comparable reference for property appraisers, affecting property valuations. Morgan Stanley's earnings report highlights an anticipation of monthly losses averaging $134 million due to the deteriorating state of the commercial real estate sector. Several other banks are facing comparable challenges in their CR holdings. For example, Goldman Sachs has reduced its exposure to office-related commercial real estate holdings by approximately 50% due to the looming risks of a full-blown crisis in the coming months. Bank of America reported a substantial increase in its total non-performing commercial real estate loans, reaching nearly $5 billion in the third quarter, up from $4.27 billion in the previous quarter. On the other hand, borrowers are grappling with the difficulty of refinancing their CR loans due to the sharp drop in property values and soaring interest costs. An estimated $2 billion worth of office commercial mortgage-backed securities, which bundle individual loans, are set to mature in 2023. If property owners fail to meet their loan obligations, it could trigger a wave of defaults, potentially leading to widespread bank failures. While consumer debt alone can pose risks for small and mid-sized banks, large banks that have extended substantial loans for commercial building construction are facing serious jeopardy. Regulators are closely monitoring banks' CR risk, and credit rating agencies are downgrading some of the largest lenders due to concerns about credit risk, prompting these institutions to take measures to mitigate their losses. The Federal Reserve's Senior Loan Officer Opinion Survey indicates that banks have been increasingly stringent in their lending practices, despite the ongoing need for borrowing by households and businesses. This has heightened the likelihood of a worsening economic downturn. The latest earnings reports underscore that banks have tightened lending conditions even further for all forms of borrowing through the third quarter, while the demand for loans remains stable. This situation is not only nightmarish for consumers but also for US businesses. Companies are grappling with rising labor costs, energy expenses, manufacturing inputs, transportation costs, and declining sales. Layoffs are becoming more common, and demand is dwindling across the board, putting significant strain on businesses' financial health. When a company already struggling is denied a line of credit by its local bank, it can quickly shift from being a struggling business to a failing one. Tightened lending conditions increase the risk of bankruptcy. In essence, banks find themselves in a challenging dilemma. If they don't tighten lines of credit for consumers and businesses, they risk facing more substantial losses and potential failure. Conversely, by reducing lending, they put businesses at risk of collapsing and defaulting on bank loans, which in turn places the banks at greater risk of potential failure. To compound the situation, these institutions are exposed to an even more significant financial shock arising from commercial real estate. Regardless of their course of action, the outlook appears grim for everyone involved. Let us know your thoughts below. Make sure to subscribe to the channel and leave a like below this video.